Most people in Canada hear the word RRSP all the time, at work, at the bank, or during tax season. But very few actually understand how it works or how powerful it can be. In this video, we'll break down RRSPs in a simple, practical way, how they save tax, how your money grows, and how RRSPs fit into your long-term financial plan in Canada. Let's start from the beginning. An RRSP, or Registered Retirement Savings Plan, is a government-approved account designed to help Canadians save for retirement. But an RRSP isn't just about saving money. It's about using tax rules to your advantage, so your money grows more efficiently over time. To understand why that matters, we need to look at why RRSPs exist. RRSPs were created to encourage long-term saving. Instead of taxing all of your income today, the government allows you to set money aside, reduce your taxable income now, and pay tax later, usually when your income is lower in retirement. This creates two major benefits: immediate tax savings and long-term investment growth. So who can actually use an RRSP? If you're a Canadian resident for tax purposes, have a valid social insurance number, and earn income from a job or business, you're eligible to open an RRSP. You can continue contributing until the year you turn 71. But eligibility alone isn't enough. What really matters is how much you're allowed to contribute. Your RRSP contribution limit is tied directly to your income. Each year, you can contribute up to 18% of your previous year's earned income, up to a maximum amount set by the government. This number is calculated by the Canada Revenue Agency and updated every year on your notice of assessment. And here's something many people don't realize. Contribution room is simply the maximum amount you're allowed to put into your RRSP. If you don't use all of your room in 1 year, it doesn't disappear, it carries forward. This gives you flexibility to contribute more in higher income years, when tax savings matter the most. Now let's clear up one of the most common RRSP confusions. Contribution room is how much money you can deposit into your RRSP. Deduction limit is how much of that contribution you can claim to reduce your taxable income. You can contribute now and choose to claim the tax deduction later, when your income and tax rate are higher. Now that we understand the limits, let's talk about what actually happens to your money inside an RRSP. An RRSP is not an investment by itself. Think of it as a container that holds investments like GICs, mutual funds, ETFs, stocks, and bonds. Your returns depend on the investments you choose, not on the RRSP account itself. And this leads directly to one of the biggest advantages of RRSPs. When you contribute to your RRSP, your taxable income goes down. Lower taxable income means lower tax payable, and often a tax refund. This is why RRSPs are especially effective for people in medium to high tax brackets. But tax savings don't stop there. Inside an RRSP, your investments grow without being taxed every year. You don't pay tax on interest, dividends, or capital gains while the money stays in the account. Tax is paid only when you withdraw funds, typically in retirement, when your income may be lower. However, this also means withdrawals need to be handled carefully. Any money you withdraw from your RRSP is treated as taxable income. The withdrawn amount is added to your income for that year, which can increase your tax bill. Because of this, RRSPs are not designed for short-term savings or frequent withdrawals. And on top of that, there's something else to be aware of. When you withdraw from an RRSP, tax is withheld immediately. Withdrawals up to $5,000 are taxed at 10%. Between $5,000 and $15,000, the rate is 20%. Above $15,000, it's 30%. This is not your final tax. Your actual tax is calculated when you file your return. Now let's put RRSPs into context with another popular account. RRSP contributions reduce your taxable income, but withdrawals are taxable. TFSA contributions don't reduce your income, but withdrawals are completely tax-free. RRSPs are best for retirement and tax planning, while TFSAs are better for flexibility and short-term goals. For most Canadians, using both together creates the best outcome. If you're new to Canada, your RRSP room starts after you earn income and file your first tax return. Your contribution room will appear on your notice of assessment. Starting early gives your money more time to grow, and RRSP benefits increase as your income rises over time. Before we wrap up, let's quickly cover common mistakes.
Common RRSP mistakes include over-contributing beyond your limit, withdrawing early without planning, and not investing the money properly. When used with discipline and a long-term strategy, RRSPs are one of the most powerful tools for building retirement wealth in Canada. Thank you for watching. For more clear, practical, and beginner-friendly Canadian finance videos, follow the channel and stay connected.